Good morning. Welcome to the investment meeting of the Teachers Retirement Board for March 5th, 2026. I'll start by calling the roll. I'm sorry. Thomas Brown.
Here. Good morning, Patricia.
Joe Barrow.
Present.
Phil Dukes. Nope. It is.
Nadia Fazolina, present.
Thank you. Gregory Faulkner. Amy Slattery.
Present and good morning.
Good morning. Victoria Lee.
Present. Good morning.
Good morning. Christina McGrath.
Good morning.
Good morning. I'm going to turn it over to the chair.
Great, thanks, Patricia. Good morning, everybody, and welcome, Nadia. A pleasure having you on board. Great. So we'll start the public agenda passport funds with the fourth quarter 2025 passport funds performance. I think Amanda's going to take that.
Yes, Tom,
Thank you.
thank you. This screen here. Probably page. Okay, so to start things off, wanted to just formally share the fourth quarter final report for the passport funds. We had previously shared a December flash report at the February meeting, but to kind of summarize the year as a whole, very, very strong year in terms of returns on an absolute basis. You can see double-digit returns looking at that one-year column really across equity markets, particularly strong results from non-US markets. But one of the things that we saw as really a key dynamic of the year, in particular in the rally that we saw coming out of the April Liberation Day recovery, was the fact that it was a kind of historically difficult period for active managers, particularly those that focus on higher quality stocks, because what rallied the strongest coming out of that market downturn was really lowest quality, more speculative names that a lot of your active managers simply don't prioritize in their strategies. Not surprisingly, right? A lot of active managers do gravitate towards higher quality names, and particularly within defined contribution programs, it's not typical for us to be engaging with a lot of those managers that are going to be looking at the riskier end of the market. So you do see a bit of underperformance from the active portions of these sleeves. So you can see that particularly within the US and international active sleeves of the diversified equity fund, looking at that one-year page, a bit of drag there from the active management, and also within the sustainable equity fund where we're seeing some relative underperformance, really driven in large part by that market environment that was very much a headwind for managers emphasizing quality in their strategies. But overall, very strong year. You closed the year of the passport funds at 23.6 billion in total assets. That was up from 21.2 a year prior. And overall returns here for the diversified equity fund up over 18% on the year. Your strongest performer, as I mentioned, coming from the non-US equity piece. So you can see the international equity standalone fund up close to 27%, and the international equity index up over 31% on the calendar year. So very strong year in terms of results. If there's not any questions, I will flip over to more recent numbers through the end of January.
Questions? Sure.
Okay. Let's see this. Yeah. So for the month of January, we had essentially a continued or a sustained rally in equity markets through the month that were supported by
robust corporate earnings that came out earlier this year, a more stable labor market. Some of that was offset by a bit of volatility tied to some geopolitical events. So, in particular, the activity in Venezuela and around Greenland, continued tariff threats. All of those caused a little bit of noise throughout the month, but we ended in a positive place for most segments of the equity markets. And you can see that reflected in the 1 month returns here for the passport funds. The diversified equity fund up 2.3% for the month of January, really with the one drag continuing to come from that US equity active sleeve, which was the one component that was down with a negative result of negative 0.36% for the month. As of the close of January, total assets in the passport funds moved up to just over 24 billion. And then our last update here is just a preliminary benchmark report through the end of February, representing or as a proxy for passport fund results. The one thing I'll just mention to be clear is that these numbers are not going to capture any of the effects of the weekend's activities, since that technically was after the close of markets on Friday. So that really has only begun to impact markets here this week. But in terms of the month of February, a little bit of a mix here for equity markets. You saw very, very strong results from emerging markets, up 5.5%. And US small caps also had their strongest month since August. But we saw a drag from tech names, so software, IT, particularly the Mag 7. And you can see that reflected here, particularly in the Russell 1000 Growth Index, which is one of the now 3 benchmarks that are part of the Sustainable Equity Fund composite. So that was down about 3.3% for the month.
Great, thank you.
All right.
Any questions?
Thanks, Tom.
Thank you. So we move on to the public agenda pension fund with a market overview and performance update and risk update from Dan. Great, thank you, Dan.
You're okay? You got a mic?
Sure, I think that's fine.
I think Wilfredo will be driving today. I think he'll probably bring it up in just a second here. But good morning, everyone, and thank you for having me yet again. It's always a pleasure to come before the board and give my little updates here.
Wilfredo came through.
Thank you, Wilfredo. Can we just jump to the next slide, please? So I guess kind of telling on what Amanda said, there's a bit of a lag here. It'll catch up, I promise. The Iranian conflict certainly roiled markets and introduced I wrote profound here, but it's more significant uncertainty over the coming months and what that will mean for your investments. That said, major U.S. equities are down about 1.5% over the last week. This morning, major U.S. markets, they're about 1.5%. Yeah. And this morning, the futures were trading down about another 0.5%. They seem to have bounced since then. So chop, but nothing you consider to be a correction necessarily. International markets, they're about 4 to 6% off in USD terms this week. The dollar drove, about 1% of that, 4.4 to 6% range from what I was able to, glean. And then yields on sovereign debt across the world are also up. I saw U.S. Treasury yields across the curve, various maturities, up about 15 basis points over the last week. So again, there certainly is some pricing activity which can have significant impact on, will certainly have an impact on your returns. The key takeaway, though, is there's really no predicting how long this will last or what the impact will have on the value of the investments overall. Whether there's a regime change or just market chop. We were sitting in a weekly rebalancing committee meeting yesterday, and it gives within BAM kind of our asset class managers and our DCIOs and and Monty an opportunity to kind of sit down. It's a good cadence that we have on a weekly basis where we look at your active weights and talk about whether there should be trading in and out of your portfolio. Usually it has more to do with raising cash and just making sure that we're in line with the balances. But we usually have a pretty good economic discussion there as well. And yesterday was no exception, particularly with the Iranian war kind of at the top of our minds. Ed Berman kind of took us around the world in, it felt like 45 seconds, but I think it was a little bit longer.
This is affecting worldwide.
Yeah, it is. What we came to, I mean, it's once my head stops spinning, you've all met Ed, and he's got a 1 in a million mind, and he reads everything, and he has deep and broad knowledge of many things. But he took us around the world very quickly. The conclusion that we came to, though, is that this is chop, right? We are long-term investors. We're not really tuned toward taking tactical bets or being reactive to short-term changes in the market, significant as they may be. And the bar that we would have for recommending any change in how your assets are allocated is quite high. We haven't reached that. That's sort of the takeaway from yesterday's discussion anyway. So there's an affirmation that we're set and we're comfortable with where we are. Notwithstanding the last few days, the equity markets are actually performing well. They continue to set records throughout January and February. We saw Magnificent Seven, tech stocks, retrace some of their gains in the first couple of months of this year, which is good news. There was some concern that the market was top heavy and quite reliant on the performance of those. So though the S&P was relatively flat for the first couple of months, a lot of that was just maybe profit taking, but price depreciation for the Mag 7. If you look at kind of an equal weighted S&P 500, that was up about 7% year to date, whereas the market cap weighted, the headline that we all see in the news, that was flat for the first couple of months. And again, the dynamic driving that is kind of the unwind of the AI valuation or the AI driven stocks. So, hey, Wilfredo, can you go back one slide, please? Still on headlines. Forgive me. One of the news items that we are really paying attention to, and I think Monty will probably jump in once I've done with the little setup here, is just that. It's the first kind of 3 headlines, right? We spoke about in past meetings quite a lot about sort of the unprecedented level of dispersion among opinions in the Fed, among the Fed governors. You recall also that Chairman Powell's term is up in May. You may have heard in the news that the president appointed Kevin Warsh to be the new Fed governor. That was generally received well by markets. It was sort of a horse race between Kevin Warsh and Kevin Hassert, if I remember correctly. Kevin Hassert was seen as a little more accommodative to the administration's policy goals of keeping low rates and promoting economic growth, whereas Kevin Warsh is historically, at least, a bit more of an inflation hawk. There is some concern, though, that as Chairman Warsh, I don't know how to put this lightly, or I don't want to put it too lightly, but that he will cave to the administration's concerns, right? He'll be a little bit more accommodative. There's concerns that the Fed will not maintain the level of independence that it has in the past. And that has huge implications for the world market's confidence in the stability of our economy, and ripple effects can run across that. Monty mentioned last month that it's probably one of the biggest stories of the year. And I think the term that Monty used was which Kevin Warsh is going to show up.
Dan's heard my little sermon about 2026 often enough that he's managed to weave it into his remarks. My only point to make is I think that we're going to look back on 2026 and there'll be a good chance that we'll see it as a real sea change or inflection point in how central banks, not just in the United States, but globally operate. In the United States, obviously, the Fed's under a ton of pressure from Trump and the administration to be more accommodative to what their interests are, which is exactly why the Fed was set up to be independent. So Trump's making a full-scale assault on the Fed's independence. And so that in and of itself represents a big change that we haven't seen in decades. First of all, secondly, if Trump succeeds, it's not clear about what America first means for central bank policy. Part of the reason that we've survived, the global economy has survived as well as it has since 2008, is because our central bank, which is sort of at the hub or at the center of central bank relationships and policy, at the slightest sign of a recession or a bad downturn, the US Fed would step up and provide tons of liquidity. As a result, we haven't had a proper recession in a long time. And that's generally a good thing. They've done a masterful job, in my opinion, of navigating those shoals. But part of the way they've done it is to not only prop up the US economy, but wherever necessary, provide liquidity to the rest of the developed world. And they've done this through a variety of vehicles, notably dollar swap lines with other central banks. This is really wonky, behind the scenes stuff, but it's exactly what's kept the global economy ticking on in the face of, the dot-com crash, the recession, well, the blow up of 2008, and COVID. And I don't know what Trump will think about those kind of relationships. Let's pray he doesn't find out, that nobody tells him, because we're better off with the status quo. And long story short, as Dan alluded to, I think there's a good chance we'll look back on 2026 and say, well, this is really an important change in how the economy is managed from Wall Street. Now, from White House. We'll never know on a certain day, okay, now it's different. It'll be slow, it'll be subtle, and may take us a couple of years to realize the true impact. But I think this has got the makings. I said I thought it'd be the biggest economic story of 2026, but as of last weekend, I may be wrong. It may be one of the biggest, but maybe not the biggest. So we'll see. So with that, I'll give it back to Dan.
Thank you.
Thanks, Monty. Why don't we move on to the next slide? Again, benefit from Monty's insights, and so you can contextualize what I'm trying to say in a way that this really adds a lot of value there. As we look at the, just jumping into some of the economic data, fourth quarter, we saw both inflation gauges kind of continue to show some moderation. The white line there is the CPI, kind of headline inflation index that we talk about. The orange line is the PCE. Again, that's the inflation measure that the Fed pays attention to. Point is, they've been kind of trending down over the last couple of years, which is a good sign. They're still stubbornly over the 2% target that the Fed likes to see. You see PCE at 3% there. Again, it's good news, but it's not quite mission accomplished there. So there still remains some concerns, some inflationary concerns to the upside. It can flare back up if we're not kind of diligent about maintaining controls. Moving on to kind of our unemployment measures. We got the January numbers that came in at 4.3%, and a fairly strong job numbers, 130,000 new jobs, which is much higher than we've seen in recent months. That doubled the 65,000 job estimate that the census had. Overall, you'd think of full employment in the 3.5% to 4.5% range. So we're there certainly. 4.3% is a pretty favorable level. However, you can see that the white line there is trending up over the last couple of years, slowly but steadily. Again, it's could be a sign that something to pay attention to anyway, in terms of the economy slowing down. Particularly when you hear about massive layoffs among Amazon, UPS, and large employers like that. That green line there, the prime age labor dissipation rate. Again, those are workers 25 to 54. That's continuing to creep up towards 30-year highs that we've seen in 1999, if I remember correctly. Again, the good news is that we're firing on all cylinders, and people are employed and spending money and working as you'd hope they would. The particularly high level, you wonder if there's maybe some early signs of capacity issues that would have to get picked up, or it could be an inflationary trend. The next slide, looking toward GDP growth. I kind of simplified this from what we've been showing you guys recently. The red line is the U.S. GDP growth, and we've plotted that alongside the UK, the white line there, and China on the green line. And again, among our industrialized peers, we're toward the top of the pack. China has been growing, at a much higher rate historically. You see that the green line always trends for the most part above the other ones, except for COVID. And so it's good news for us. We are still growing at a healthy, robust rate. Though we're still below China. I noticed there's an article actually in the Times today that China actually revised their 26 growth estimates down below. They have a 4.5% to 5% target this year, which is the first time they've plotted below 5% since 1991. So again, just signs of headwinds in their local economy, but they're giving themselves rooms to make some adjustments rather than trying to reach a particularly high number. Looking at interest rates, thanks, Wilfredo. Again, we noticed that we talked about this last month, but the Fed cut rates down to 3.75% in their January meeting. Yeah, maybe it was December. That puts us in line with where the Bank of England is. Again, we're showing the three. We're showing alongside the Bank of England and the ECB. You see them sort of trending in similar directions. 3.75% is, if you're looking forward, we're expecting perhaps 2 more rate cuts in 2026 if you look at the Fed dot plots. Again, a lot of dispersion in that number, difference of opinion. Some of the governors have it up, have us increasing rates. Others have us decreasing rates more, but it plots down to perhaps another 2 rate cuts as of now. ECB likely to follow suit. They have some headwinds in the economy as well, so we could expect some rate cuts in 2026 from them as well. And I'm sorry, that was the Bank of England. I would expect that. The ECB is likely to hold at 2% for the foreseeable future. Next Fed meeting, March 17th and 18th. And again, we're not expecting a change in that particular meeting. Moving on to the yield curve. Again, it's another kind of simplified slide. We used to show you a bunch of lines throughout history. We're showing you where the yield curve is today and what's important about it. And it is just that it is normally sloping and robust. So we're being compensated again for investing in treasuries. That gray shaded area you'll note is maturities. It's a plot for maturities between 2 years and 10 years, and the spread between the 2-year and the 10-year maturity yields is 56 basis points. Again, a healthy indicator that the economy is operating normally. You're receiving term premium for investing in longer term assets, and it's healthy for bank functioning and again, a great indicator of a strong economy that's operating normally. Credit spreads, the next slide there. Again, this is the amount you're being compensated for investing in investment grade or high yield securities. Those spreads that we have there, 295 and 83 basis points respectively, are still quite tight. The straight lines you see across, that's the 25-year average for those rates. So you see we're plotting quite below them significantly. Again, a good sign that money is flowing freely. Investors are not they don't need to be compensated at a particularly higher level for taking additional risk and investing in corporate debt. And the only other note I'll make here is that when rates do increase, they do so significantly and quickly, and that implies a fairly large price correction when that occurs. So something to watch out for. You'll also notice, of course, that they come back down over time. And then we'll just kind of setting us up for the quarterly performance review. Again, these are market returns. I'm kind of repeating a lot of what Amanda said here. But for these indices, again, I'll just note that particularly strong performance in non-U.S. markets last year. Again, partially a function of a weaker dollar. Also, just because capital flows were going into those markets, possibly at the expense of the U.S. markets. Again, we saw capital flows going in there, which bid price come down. The real important part of this, though, is that gray column off to the right. And again, those were the long run expected returns for each of those asset classes back in 2023, the last time we revisited the strategic asset allocation. The 6.7% expected return is the Russell 3000. You can see that we've kind of knocked that out of the park, but particularly over the last 3 years during the time that we've had this asset allocation in place. But that applies a couple of things. First, it's great news for the portfolio. Earned quite above and beyond what our expectation was when we proposed and you approved that strategic asset allocation. The portfolio had an expected return of 7%, right? And obviously you've outperformed that over the last couple of years. Again, this is what's driving it. It's these market dynamics that really kind of help you exceed that bogey. The other thing I'll mention on this chart before we move forward, so I'll tie back to it in a minute. The 5-year numbers, the only red you see on the chart there is investment grade and government debt on the 5-year thing. What drove that was rate expansion. So, after COVID, coming out of COVID in 2021, we saw quite a lot of inflation. The Fed's reaction to that was to raise interest rates, and that rate expansion drove fixed income pricing down. And that impacts the 5-year number. Markets had recovered, and we'd taken our hit between 5 years ago and 3 years ago. So that's why you don't see it playing through the 1-year numbers as much as we do. So again, just it kind of illustrates the market disruption that you see back in the time frame. Why don't we jump into your quarterly review here? Before I talk about this slide, a little bit of a mea culpa. The slides we posted to Convene last night actually were referencing a different pension system. And the reason for that, a little bit behind the scenes, we color code a lot of these charts to make sure that we don't mix up things like that. But as it happens, Teacher's Gold looks a lot like NYC's Orange. No, it looks pretty much the same. Yeah, looks a lot like NYC's Orange to a guy who's on a deadline. So we happily, my colleague Kim Boston caught that this morning. We've already reposted updated slides to Convene, and then it looks like this. So representing properties. So I do apologize for the mistake. At any rate, all this slide does is the dark blue line there is a 7% return, a level return. What your expected bogey is. If we were to invest $1,000 and earn 7% over a period of 10 years, you'd land just under $2,000, be $1,967, and that's how that plots through. If you put that same $1,000 into the teacher's portfolio, your fixed return funds or the QQQ returns, the squiggly line, if you will, you're landing at just under $2,300, reflecting an 8.5% return that we've seen over the last 10 years. So again, good news, great implications for funding ratios, great implications for city transfers, and again, just indicate a real strong markets over the last couple of years. Moving on to portfolio composition. Again, this slide is just a pie chart and a dollar chart, just sort of level setting, and it mimics a lot of what you've seen in your quarterly reports from Convene. But again, you're about 45% in public equities, a third in public fixed income, the remainder in alternatives. We remain pretty close to your strategic targets. We try to keep that as within a 1% range at those high levels, and we look at it on a weekly basis. So pretty close to the mandate that you gave us a few years ago, and that's where we are. Moving into your returns, plan returns. Again, this chart and the table below it. We'll just let Wilfredo catch up for a second here. There we go. Thanks. Your fourth quarter returns at 2.2%. Again, you're plotting a little bit below the policy. You're a little bit below the public market equivalent return, which would be a 65% mix of public equities and 35% of US fixed income aggregate. And then you're also a little bit below, the TUCs, which are, your peers among other large pension funds. A couple of different phenomena playing out within these numbers. If we look at the total plan versus the policy returns for any of those periods, that's driven a little bit by individual manager selection. It's driven by the amount by which we deviate from, the targets. Sometimes it's functional. We typically don't though. And it's also driven by sort of a mismatch between the benchmarks that we have set as policy, which are usually linked to public markets investments, and for private markets, which have different pricing dynamics. We talked about that a little bit in the last couple of months, but that's what drives a lot of those differences. What you see us teasing out when we compare the returns to the 65-35 portfolio is just that. It's usually the private nature of some of our investments and the fact that they have different return profiles. And then there is a bit of a deviation between, your actual equity exposure and that 65%. So that changes over time. So when you start looking at 10-year numbers, you really see that playing through a little bit more. So before we move on, I just want to see if there's any questions, anything to address. Questions for Dan? Good. Okay, great. So we'll just jump into your strategy returns and run through these. Get two kind of subsections left here. These are your public market returns, again, going from 3 months out to 10 years. Again, net returns, so the net of manager fees. And again, pretty good news. The only negative that you see there is within the core fixed income. And again, that's that dynamic of the rate expansion when the Fed was hiking rates in response to inflation, 2021 and 2022. Again, I won't belabor the point, but stellar performance of, the 1 and 3 years on the public market space, and it's really kind of boosted portfolio performance. As we move into the returns relative to the benchmark, not terrible news here. Again, U.S. equity, you're tracking your benchmark fairly well. The negative excesses that you're seeing in the world ex-US or your developed markets portfolio is driven by some of the active managers in there. We won't get into it here, but happy to answer any follow-up questions. We move into executive, and also I'll remind you that Ed Berman is rolling out the Mars process. He spoke to you about that the last month or in December, but he's giving you a review, I think, next month, and that's when you really kind of get into the managers that are performing, how the managers are performing, what's driving their performance, and what we're doing about it. So just a bit of a preview and a bit of a plug for that product, because it's a kind of it's foundational. It's a great tool. Any questions here before we move on? Okay. Looking at your alternatives, again, these are going to be lagged a quarter. Just has to do with how quickly those managers can report back to us, and we want to give you, the actual kind of final numbers. So these are sourced mostly from your consultants, and just reflexive of the fact that there is some lagging in the reporting itself. Pretty good news across the board. Not public markets returns, but positive and solid performance, especially when you look out at those longer periods, the 10-year. Private equity earning 12%. I mean, that's a pretty good 10-year number. Private real estate, again, a bit of weakness in the 3-year, has to do with some inflationary pressures, has to do with some stress in that market. But again, you can see that the returns are starting to rebound, and the long-term nature of our viewpoint is paying off. Look at these returns relative to their benchmarks on the next slide. Again, you can see the red there in the private equity space. Again, I tend to be an apologist for this kind of stuff. I need to be. This is a reflection that the public markets have performed so well. We've all made money, right? The private equity performance is clipping along. It's doing what it's supposed to do. We hope for returns in excess of public market returns. we are paying up effectively a liquidity premium for investing in that space. The managers are in control of when they call capital and distribute it back to us, and that's worth something to us. That's why we have a 300 basis point premium on that. But you really can't control for the fundamental runoff you saw in public markets, and that's really what's driving a lot of those numbers. Real estate again performing pretty well. That's relative to the Odyssey, and actually there should be 100 basis point premium on that. I double checked that this morning. My apologies, but that's performing pretty well. Infrastructure, alternative credit, again perennial strong performance relative to their benchmarks. Any questions before we move on? Okay. And then finally, just a quick review of the risk. Little feedback, the data here is a little bit dense and could be a little bit tough to read. It's really meant to be kind of a quick visual, right? If you think of the portfolio risk as how much you can expect the portfolio to gain or lose in any time frame, right? We've simply scaled that down to expected returns for a quarter. And that's what those bars represent. How much, 2/3 of the time you'd expect to gain or lose either in the portfolio or in any of those strategies or sub-strategies. And then those orange triangles are actually how you performed in the last quarter, in the fourth quarter, right? Those are accounting returns, which are, for alternatives, it's a little bit different than the returns we report for you on a lag basis, but it's over the long run, it kind of evens out. The takeaway here is last quarter, you didn't see the stellar performance you saw in the third quarter, but it was positive. It was within the expected range that we'd hope to see. And, pretty good news. If we move into our last slide here, just the portfolio risk summary, I always tend to get bogged down in this. So I'm going to give you the highlights, and if you have any questions, I'm happy to jump into the detail. But again, what we're trying to demonstrate here in the table, we'll focus on leader broccoli before we get to the meat of it. We're comparing a market portfolio, which is a 65-35 mix of public investments, to your policy benchmark. So again, that's how we set the strategic asset allocation about 3 years ago, and then we compare that to how your portfolio actually performed. The headline there is you're taking a little bit less equity risk in the portfolio, both from a policy and an as invested basis. We're taking a little bit less rate risk. You see that playing out in the rates duration and the spread duration than the 65-35 market portfolio. And you can see that we're taking a little bit less risk than that 65-35 portfolio as well. It's when you get down to the portfolio risks there. So the portfolio as invested is at a 9.5% annual volatility or risk, compared to 10% risk you take if you just kind of blindly index the fund to a 65-35 bogey. The active risk at 1.8% is I'll move into that in a second, but tightly bound. It's about what you've been running for the last several years. If we look at the tables on the right there, or sorry, the charts on the right there, you can see same kind of observations as last quarter. You see risk across the board popping up. Again, that was in relation to the tariff announcements in April last year, and it's been kind of trickling down steadily ever since. And we're pretty much back to, we're still a bit higher, but we're getting close to where we were prior to those announcements. So again, the market has assessed the impact of those and sort of evened out. We'll see how we plot out next quarter after the Iraqi invasion. The chart at the bottom there, again, that is just your active risk, so that 1.8% for December. We're just looking back at it over the course of the year. You can see it's fairly tightly bound from 1.7, 1.9%. Again, good news, just since the portfolio is acting as we'd expect it to, it's invested fairly close to its benchmark and not displaying any outward active risk at any point in time. Do you have any questions on this material? Or kind of anything I spoke about? Actually, this that kind of concludes all my slides.
Thank you, Dan.
Thank you.
Any questions for Dan? Great, so that brings us to the end of our public agenda. We have a motion to move into executive session. There a second? Great. All those in favor of going into executive session, please say aye. Opposed, say nay. Abstentions, we're now in executive session. Thank you. Abstentions, we're back in public session. Liz, you'll-
Good morning, Mr. Chair. Good morning, everyone.
Good morning, Priscilla. How are you?
How are you? Sorry, I can't see everyone, but I can definitely get to the readout. In the executive session of the Passport Fund, there were 2 manager updates. In the executive session of the Pension Fund, there's an update on preliminary performance. The board had a presentation on a private equity partnership. In conclusion, details to be made available at the appropriate time. Thank you.
Thank you, Priscilla.
Thank you.
Are there any questions before we ask for adjournment? Great, thanks again, as always, to Janice, our TRS tech, and to Will, our report. Much appreciated, guys. And with that, I'll entertain a motion to adjourn. Oh, it's been moved, and is there a second? It's been seconded. All those in favor of adjourning, please say aye. Aye. Opposed, nay? Abstentions? We are now adjourned. Thank you, everybody.